Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to another episode of Tax Smarts Unlocked. I'm your host, David Robson, and today we're diving into the world of 1031 exchanges and the importance of having a backup plan. You might be wondering, what exactly is a 1031 exchange? Well, in its simplest form, a 1031 exchange allows you to defer capital gains taxes on the sale of a property by reinvesting the proceeds into a like-kind property. This is a valuable tool, especially for real estate investors looking to maximize their investment potential. But, as with any financial strategy, it's vital to understand not just its benefits, but also the potential pitfalls and how to navigate them. Let's start with the definition and purpose of a 1031 exchange. Essentially, a 1031 exchange, named after Section 1031 of the Internal Revenue Code, permits a taxpayer to defer paying capital gains taxes if they reinvest the proceeds from the sale of a qualified property into another like-kind property. The advantage here is the deferral of tax, which allows you to keep more of your money working for you in a new investment, potentially growing your wealth over time. However, it's crucial to note that this doesn't eliminate the tax liability. It merely defers it until the sale of the replacement property. The disadvantage is not all exchanges complete successfully, and you are also just kicking the can down the road, and eventually will have to face a tax bill. Now you might be asking, what exactly qualifies as like-kind property? The IRS is quite broad in their definition, allowing for exchanges of most real estate properties as long as they are used for investment or business purposes. For instance, you could exchange an apartment building for a strip mall. However, you cannot exchange a personal residence, so it's important to consult with a tax professional to ensure your properties qualify. The benefits of using a 1031 exchange are significant. By deferring the capital gains tax, you have more capital to invest in your next property, potentially resulting in a larger investment value over time. This can provide a substantial boost to your long-term investment strategy, as the tax deferral allows for more compound growth of your investment compared to if you paid taxes up front. However, this powerful tool does come with its own set of risks, especially in a fluctuating market. One of the primary risks is the identification period. After selling your property, you have 45 days to identify potential replacement properties, and 180 days to close on the new property. This timeline can be challenging, particularly in a volatile market, where property values can shift rapidly. Failing to meet these deadlines means your exchange could be disqualified, and you'll have to pay the capital gains tax immediately. This is why having a backup plan is not just a good idea, it's essential. A well-thought-out backup plan can save you from unexpected pitfalls and ensure you don't end up paying more in taxes than you had planned. So how do you develop a robust backup plan? One key strategy is to have multiple potential replacement properties lined up. This way, if one deal falls through, you have others to fall back on. It's also wise to have financing or cash reserves ready to ensure you can close the deal within the required time frame. To better understand this, let's look at a case study. Imagine a scenario where an investor sold a commercial office building to fund the purchase of a multi-unit apartment complex. The investor diligently identified 3 potential apartment buildings within the 45-day period. However, due to unforeseen complications, the first 2 options fell through. Because the investor had a backup plan with a third property, they successfully executed the 1031 exchange. This case illustrates the importance of having multiple properties in your plan and not putting all your eggs in one basket. On the flip side, let's consider a cautionary tale. Another investor sold a retail space and identified only 1 replacement property, confident it would close with no issues. Unfortunately, the deal encountered delays and eventually fell through. With no backup in place, the investor faced a substantial capital gains tax bill. The lesson here is clear. Always have at least 2 or 3 identified properties, even if you strongly favor one over the others. Another critical component of your backup plan is understanding the financial implications and consulting with a tax professional. Tax laws are complex and subject to change, so having an expert guide you through the process is invaluable. They can provide insights on optimizing the exchange for your specific financial situation, ensuring that you're not just compliant but also maximizing your benefits. In my experience, one of the most common misconceptions is that 1031 exchanges are only for wealthy investors or those dealing with complex, high-value properties. This couldn't be further from the truth. While certainly beneficial for large transactions, the principles of a 1031 exchange apply to any size of transaction as long as it involves like-kind properties. Additionally, some believe that their primary residence can be used in a 1031 exchange, which is not the case. These misconceptions underline the importance of thoroughly understanding the rules and having a plan. So, what actionable steps can you take to prepare for your own 1031 exchange scenarios? First, start by creating a detailed timeline of the exchange process, clearly marking deadlines for identification and closing periods. Consult with a qualified intermediary, familiarizing yourself with their role, as they will handle the proceeds to ensure your compliance with IRS rules. Most importantly, work with a tax expert to tailor a strategy that aligns with your financial goals and risk tolerance. To sum up, while the 1031 exchange is a powerful tool for deferring capital gains taxes and enhancing investment opportunities, it requires careful planning and execution, especially in an unpredictable market. Having a backup plan is not just a smart move, it's a necessity to protect your financial interests. Consulting with a professional and understanding every part of the process can make the difference between a successful exchange and one fraught with costly mistakes. Remember, the key to unlocking the potential of a 1031 exchange lies in preparation and informed decision-making. As we wrap up today's episode of Tax Smarts Unlocked, I hope you've gained valuable insights into the world of 1031 exchanges and the critical need for a backup plan. We've covered the basics, potential risks, and strategies for a successful exchange, along with some real-life lessons that underscore the importance of being prepared. Remember, a little planning goes a long way. And as always, consult with a tax professional to navigate these complex waters successfully. Thank you for tuning in, and don't forget to join us next time as we continue to explore more ways to lower your tax bill and secure your financial future.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.